All right, we are live. Hello, everyone. Welcome. Glad you could join us today. Good morning for our friends in the US and good evening to everyone here in Europe. We've got over 400 people planning to join us today. So we're just going to wait a couple minutes for everyone to get logged on before we jump into the content. But in the meantime, what you can do is go ahead and introduce yourself in the chat section. So let us know where you're tuning in from, maybe what SaaS company you work for, or something you're hoping to get out of the presentation. And we'll see who is joining us. We've already got over 100 people on, so excellent. Hey, Luciana, I see some familiar names. Raphael, hello. Thanks for joining from Paris. Who else is out there? Over 100 of you. All right. Aymeric, Melanie, Bart, hello, welcome. Thanks for joining. All right, the chat is alive. I can't even keep up. Hey, everyone from all over the world. Really happy to see so many folks joining us for today's conversation. Will this be recorded? Yes, we always record. We'll share it afterwards in an email. So if you have to hop off early or miss anything, you can rewatch it, no problem. Hey, Doug from San Francisco. Good morning. Oh, Hong Kong. Hello, Arno. Great. Well, great showing from all around the world. Well, I know you're all busy people, so we will go ahead and get started. First, just a short introduction. My name is Dominique, and I help lead the community at CFO Connect, which is a global network of modern finance leaders. And I see a lot of our members out there. So hello, and thanks for joining today. We host events and workshops like this one right here. We have a private Slack group for CFOs and produce tons of helpful content on our blog. So feel free to check that out. We'll push a link in the chat that you can check out later. And if you are a finance leader, we'd love to have you join the community. It's completely free, but there is a short application to complete. So we'll add a link to that as well. A little background on CFO Connect. We are a community that was created by Spendesk. And if you're not familiar with Spendesk yet, it's an all-in-one spend management solution that combines spend approvals, company cards, expense reimbursements, invoice management, automated accounting, all in one super easy solution that finance teams love. So of course we had to mention that today. And if it sounds interesting, we welcome you to check it out. But today is obviously not about sales pitches. We're going to talk SaaS finance, understanding and speaking the language of the SaaS industry. And I'm super thrilled to have Will Cords from KPI Sense here to lead the discussion. He's a wealth of knowledge and experience on the topic, as you will soon see. So before I pass it over to him, just a quick note on how you can interact with us here today. You'll see there is a questions tab that you should put your questions in. We're going to keep an eye on that throughout the presentation. So we will answer your questions as we go. And you can also upvote questions from other people that you'd like to see answered. And we'll share some polls throughout the presentation. So you're welcome to participate in those too. So finally, I'm going to pass it over to Will to introduce himself and get the conversation started. So over to you, Will.
Thanks, Dom. It's a pleasure to be speaking today. I really appreciate the time and the opportunity to talk SaaS. This is kind of what I live and breathe, and this is something we've obviously looked forward to for the last month now. So so I'm Will Cords. I'm from Chicago. My company KPI Sense, we were established back in early 2019 and are trying to make SaaS finance easier and more accessible for everybody else out there, regardless of aptitude and where you're at today. So with that, maybe be able to go to the next slide. So yeah, just a little bit more about us before we hop into it. Basically, we are a finance as a service business, so kind of a unique model, but we're taking tech-enabled automation and pairing that with kind of SaaS expertise and providing kind of services, in kind of a more tech-enabled solution for founders and for kind of CFOs and finance teams. So for earlier stage SaaS and kind of tech-enabled businesses, more focused around building scalable models and helping drive growth and optimizing business for kind of fundraising processes or other inflection points. Later stage companies, we are a very cost-efficient kind of resource replacement for FP&A or senior financial analyst heads. So we work with a number of companies today. We've got over 40 clients, and I've had the opportunity over the past really 6 years, even when I was doing this work more on a consulting basis, to support a lot of interesting businesses, and we've seen a lot. So if you have any questions on the SaaS side, on the finance side, happy to answer those during the presentation today, or even afterwards. I'm happy to kind of talk further in Slack, via email, etc. So yeah, keep the questions coming. We want to make this as interactive as possible. But really, our view here from KPI Sense's perspective is really just trying to help SaaS companies and make finance type work more automated, more efficient, and ideally help drive better decision making and kind of better process over time. So with that, I think it probably makes sense to go to the next slide. So what are we going to cover today? I want to give a brief intro on kind of SaaS KPIs. I won't take too long. I know a lot of people here are seasoned finance veterans here. So what I want to try to do today is I think cover some ground bases for folks that don't have as much SaaS exposure, and also dive into some more detailed stuff for maybe the seasoned SaaS veterans that may have joined us today. So we'll cover some best practices stuff, and then tackle some focus metrics type information. How we would look at it and build a dashboard, and how we would start to analyze some of this information. So, and again, along the way, if you have any questions or thoughts, let me know. Also, the deck will be going out, I think, after the call. We've got some stuff in the appendix around how we define some of these metrics, how we analyze some of this data. So if you're looking for kind of more content to, I guess, kind of work through, should be able to do that after the call. So with that, let's go to the next slide. So what is SaaS, right? This is, obviously, I think most people know what SaaS is. They think they kind of understand the concept of SaaS. But basically, it's a model of buying software without truly owning it from kind of a perpetual license or a permanent basis. So if you think back to kind of the early 90s, early to mid, late 90s, and early 2000s, companies largely were selling perpetual licenses. So you would pay a large amount for a software deal. And then for enterprise deals, you were likely paying some sort of maintenance or others type of additional kind of cost, the kind of the beginnings of what, would become, recurring revenue. But as time passed, I think, especially with the emergence of the cloud, companies realized that there was another way. You didn't have to buy a perpetual license or buy something up front. You could pay a lower cost, more of a subscription. And one of the earlier companies to do this was Salesforce. They kind of predicted or thought that there was an end to kind of the era of enterprise software. And why I guess why does that matter, right? I mean, why is it important for today? I think understanding SaaS is really understanding kind of the business model. This whole concept of recurring revenue, deferred revenue. The beauty of a SaaS business versus somebody who sells T-shirts or somebody who sells a physical product or something that's largely kind of driven by physical interaction or other kind of consumer needs. There's a constant need to drive in business. I think one of the reasons, and especially why SaaS has been so resilient through kind of COVID, is this concept of net revenue retention, right? So if I book business without having to go and sell new customers, if I have strong net revenue retention, I want to have all of that business the following year. So very attractive business model, very interesting from that perspective. And over here on the right, you've got some tables, pros and cons. I built this table 5 or 6 years ago. So don't give me too many negative points for the lack of design here in a lot of text, but it's just something helpful to share and talk about. And I think it's helpful for companies that are legacy software businesses that are moving over to a SaaS or subscription model. There's definitely some considerations there. But with that, let's go to the next slide. So KPIs, what are KPIs? Why do they matter? What I would say is KPIs aren't just vanity metrics to show your investors, your board, or your team, right? I think they can be extremely valuable in driving better decision making and ideally kind of driving better business performance. So, but it's really important to understand, what they are and how they work. And I think, other than just being kind of key metrics that you're tracking, you want to be able to utilize and analyze those in an efficient way. So, A couple of kind of questions here around what are the right KPIs to track, how do we evaluate and kind of review those over time, and how do we use KPIs to make better strategic decisions within a business. We'll cover some of the things that we're tracking for a typical SaaS business and some ways that we can kind of customize and work through that. But just at a high level, I think it's important to kind of take a base view there. And with that, let's hop over to the next slide. So why does it matter, right? And again, I think I touched on this a couple slides back, but first of all, finance isn't easy for SaaS companies. The standard kind of QuickBooks and kind of tech stack solutions that you're going to use aren't really built for deferred revenue and kind of complex revenue recognition. There's a lot of manual entries, a lot of complexities involved there, which makes collections and AR and even analyzing that data a little challenging, especially if you're using a subscription management tool or if you have a large number of customers. Tracking revenue recognition can be pretty painful. So when you're really trying to analyze that data, looking at financial statement data and then transactional data and trying to get some of these KPIs or metrics, from that standpoint, I think it's definitely one of those things that can be, a little more challenging to kind of track and maintain. The other piece of this too is that the finance leaders across the board are being asked to do way more. So in 2019, there was a Kaufman Hall study. This was largely directed at finance CFOs working in financial business related businesses. But I think the numbers apply. 95%, so an overwhelming majority, said companies should be doing more to leverage financial and operational data to inform strategic decisions. And 94% are increasing greater pressure to do that. So there's a better need and they feel like they need to do more, but there's also kind of this pressing need to drive kind of more efficiency from that standpoint as well. So with that, can we hop to the next slide? Yeah, it looks like I think a couple of people were looking if we can zoom in the slides. I don't know if there's a way to kind of increase the size of that at all, but would love to do that if we can. If not, no worries. But so high level, I actually circled up with the CFO Connect kind of SaaS group in Slack and asked a couple of questions. One of those was around chart of accounts, and this is something that we deal with pretty consistently. It's something that, again, QuickBooks is not built for SaaS companies. So one of the things that we like to look at and analyze from our perspective is really kind of making sure that there's the right structure in place to go and analyze this information in an efficient way. And by doing that, our big kind of focus points, to try and drive that are really around, kind of making sure that you have the right structure. So, the first thing that we do is really building out a functional P&L. So for a lot of the later stage businesses out there, you're probably already doing this to some degree, but I think being really consistent about how you allocate those headcount costs, it's going to allow you to track and measure these metrics really efficiently. So that's one of the first things that we focus on. And there's some kind of SaaS unique elements, right? You've got some of these unique costs that go directly towards supporting revenue, like customer success. Those are people that are going to help typically with the renewal process. You've got hosting costs that are going to typically support typically the cloud instances that are supporting a lot of that customer data. So from that standpoint, I think just making sure that you've got some of these levers in place. But we've kind of attached a chart here. We actually have a link to an article from our side that we're happy to share as well that has some more of this information. And if you're ever looking for any help here, feel free to reach out. We're happy to kind of talk through it in more detail. But the last thing I would say here is don't try to get too aggressive, from that standpoint. I think you just had it back there. It was just zoomed in a little bit further. Either way, all good. But yeah, so from that standpoint, I think that there is, we definitely encourage folks not to get too rosy-eyed in terms of how they look at expenses. So, one thing, there's a lot of times people will try to move sales and marketing expenses down to G&A or be a little bit aggressive with how they're kind of working this out. What I would say is that I think whatever you can reasonably justify is worthwhile. That at the end of the day, you don't want to inflate your customer acquisition cost. You don't want to drive, inefficiencies with some of these metrics. It's ultimately going to, I'd say, kind of drive less efficiency with kind of how you're analyzing and looking at this data. So from our standpoint, we definitely would recommend erring more on the side of caution if you're going to actually analyze and look at this data in kind of an efficient way. With that, let's hop to the next slide. So what are kind of the best practices for building a dashboard? I think the biggest thing is data quality is king. And by that, what I'm really saying is it's really important to have good financial data. If you've got funky transactional data, or you've got information come from different data sources, like say your Salesforce instance, but the Salesforce instance doesn't have good data. As a somebody in a financial role, you're likely seeing what data is good versus what data is bad. But trying to build a dashboard, and this is relevant for all companies, not just SaaS, without having good source data or data that you're confident about, you're wasting your time. So again, that time is probably better spent finding a better source of truth or kind of getting a sense for what that looks like. One of the things that we do at KPI Sense is we're very focused on looking at those data sources and building automation and structure around it. So, regardless of if you're somebody that works with us or not, we always recommend trying to build process and structure around how you analyze the data so that there's less room for human error or, you looking at a formula the wrong way, or, a formula doesn't track. So when you start to hard code that data in, there's a lot more opportunity for this stuff to get a little more messed up. And additionally, I think it's really important to define what the use cases are for using the data. It's very easy to say, hey, we're going to look at this metric to drive how we kind of look at business performance. And then after 2 bad months, you say, all right, screw it, we're going to stop looking at that. I think it's really good. The good and the bad can be very helpful in kind of educating and driving better performance. So definitely would advocate being consistent. And lastly, one question we get a lot is, there is no golden metric, right? I would never say make a decision solely based on one metric being really strong versus the rest. I think it's really important about telling your story, right? And building kind of that narrative around where can we see business improvement and drive it. So I think it's contextual amongst all these other resources and kind of visuals and views. So, from that standpoint, I do think it's helpful to think about, again, just trying to drive a little bit further efficiency, in that sense. Cool. If we go to the next slide, that'd be great.
Yeah, just a sec. I want to do a quick check on the visuals and see if we can get a better zoom on these.
There you go.
Does that help?
That looks, I think that's, yeah, that's a lot bigger.
Okay. Let me just, okay. Great. Are you ready for the next slide?
Let's do it.
All right.
So let's talk some SaaS metrics, what you're all probably here for to some degree. So some of these may be a little bit more elementary for folks on the SaaS side, but I think what we're going to do is not just talk through how we think about the metrics and what they look like, but how we can analyze that to drive better business performance. So really starting to use this to be a little bit more analytical and more strategic with some of this data. So with that, I won't go through all of these kind of metrics individually. I'll kind of talk through this in the context of a hypothetical dashboard. But I think it'd be helpful to hop to the next slide just so I can start kind of talking through that. So let's start with customer metrics, right? What you're seeing here, we've got a hypothetical dashboard for 𝐀𝐻𝐳𝐧𝐧𝐞𝐜. That's our standard demo company, a company that we make up. I probably needed to come up with a better name, but something that I've used, since day one. So what we're going to show is kind of a couple different segments of what a very stereotypical, or not stereotypical, a hypothetical dashboard would look like for a client or somebody that we work with, right? We have kind of a default dashboard, and most of the stuff that we're going to walk through today are things that we typically incorporate. But going beyond that, it's not just the dashboard and what it looks like. I think it's really about how you look at and analyze the data. So what I'm going to try to provide is some commentary and feedback and questions that we're asking around the data that we're seeing to try and tell that story for your business, that makes it a little bit more unique. So everybody's got a unique business, right? There's all things that make your business more unique than a different SaaS business or even a non-SaaS business, right? But I think if you're able to look at this information efficiently, you're going to be able to drive better decision-making. And I think you're going to be able to deliver more value to non-finance areas of the business. So to me, this is a great way for a finance, a CFO, or somebody who's looking to get more involved from an FP&A or reporting standpoint to drive more thoughtful and meaningful conversations across the business. So in terms of customer metrics, what you're seeing here is just a high-level customer count and total customer logo churn. So basically, how many customers are we losing in a given period, right? And there's a lot of different ways to calculate this. What we're doing for our metric is we're taking kind of a last 12 months view and summing that up to get to kind of that last 6 months view. And actually, that last 6 month view is going to be annualized. So you're seeing more of an annualized number. One thing I would note here, customer churn can be a little bit deceiving. You could have these customers, like let's just say in June 2020, those 10 customers who churned could all be paying you $1 a month, right? So there's a lot of ability to impact customer logo churn without looking at the effect of dollars. So one thing that we like to look at and kind of as an adjacency here is average revenue per account, right? Are we seeing impact there? If there is an uptick in churn, are we continuing to grow the value of our accounts? Now, part of this could be you may have a very standard kind of pricing model. You may not see a lot of fluctuation here, but if you do have a model that allows you to expand pricing and to grow customers over time, it's something great to look at. And the other thing I think is just understanding, and tracking customers from a sub-segmentation standpoint. So one thing that we spend a lot of time with our customers is really focusing on diving further into the data. What other qualitative or quantitative factors can we pull in to analyze your customer base, right? And this is something all of you can do as well. Start to look at information like, where do we look at customer cohorts? When did they join? When did we sell that customer? What end market are they in? If you're selling to multiple business segments like SMB versus enterprise, what do these metrics look like across the board? So, with the right framework, you're able to look at the customer count on that perspective, and you're also going to be able to look at kind of more of the revenue driving metrics as well. So with that, it's probably a good time to transition to the next slide. So in terms of the recurring revenue metrics, this is where I love to spend time. Really understanding kind of your MRR trends and kind of what that looks like is really important. Now, one thing that we would note, even for SaaS businesses out there today, there can be some inconsistencies across some of the standard, I'd say, metrics or recurring revenue type of solutions out there in the market. And that's not a fault of their products or anything like that. There just may be some deals that are marked as one time or have, maybe more inefficient, revenue patterns. Maybe you have a customer that pays you, they don't pay you 1 month and you're on a cash basis, but they pay it twice the following month, right? So if you're looking at this, what I would say, it's really important to look at your business in the context of what you're doing. And really trying to, what we're trying to do here is identify the broader trend of where the business is heading, right? If you have tens of thousands of customers, it may be hard to get this down to a true dollar for dollar view of what your recurring revenue actually is. But we think of it more as like a 90-10, 95-5 type of analysis, where if you're overwhelmingly accurate and you have a few outliers, that's okay. Again, this isn't GAAP information. You're not sending this to an auditor. You're not filing this for your tax returns. This is really to analyze the business. So getting good trended data is going to drive a lot of efficiency. But the one area that we spend a ton of time talking about is net revenue churn. And why does that matter? So gross revenue churn is basically the worst possible number you could show in terms of what's happening with your business. That's what your revenue roll is versus what customers you've essentially lost, right? So who's kind of left the business. There's no way to really improve that, on the surface and looking kind of on a backwards basis, other than driving more efficiency, more kind of efficiency from in terms of how you're viewing that, or driving kind of better efficiencies from your customer success view. But one area where you can really start to kind of recover and recoup some of that churn percentages and some of those lost customers is with your net revenue churn. So that includes expansion. That's going to be including opportunities for price increases, other types of views that allow you to kind of drive further efficiency there. So really, where we spend a lot of time is what can you do within your kind of within that expansionary revenue opportunities to drive further efficiencies. So there's a number of things that we look at. Customer success. Do you have a team or a group of folks that are working with renewal customers and driving further efficiency there? That's one area that can drive a ton of efficiency with net revenue return and drive you to a net revenue retention number over 100%. So that's basically 100% less than 9.1% and the 4.4% you're getting over here. So if we're able to drive enough expansionary activity, we can actually exceed 100% net revenue retention, which, going back to that example from the first couple of slides, if you have that and you have that over the course of the following year without selling a single new customer, you're going to have the same amount of revenue next year as you do this year, which is awesome. So really, there's things like customer success. There's things like, again, pricing increases that you can bake in. Having kind of natural expansionary opportunities for your clients is awesome. And lastly, one thing that we really advocate for is moving from monthly and quarterly payments to annual payments. If you can drive better payment cycles from your customers, even if you're taking a pricing discount to some degree to do that, it's going to allow, it really makes everything in the business better. It drives better net retention. It drives better kind of working capital and cash flow cycles. And it's just going to make your lives of your customer success and your renewal team easier because it's less money that they have to worry about renewing on a given period. So really one thing that we're focused on and trying to drive further efficiency within our customers. With that, let's hop to the next slide.
Yeah, actually, Will, if you don't mind, if we could pause here for a moment. This is really helpful, specific information, and we're getting some questions. So one of them is from Leo. He asks for any recommendation on software to track QRR and ARR as opposed to MRR for tracking and forecasting recurring revenue instead of Excel.
Yeah, I mean, there definitely are a lot of tools out there. There's a number of subscription, revenue tools. There's folks like ChargeBee, SaaS Optics, Chargeify. I'd say for enterprise software, we typically see people working more with folks like SaaS Optics or ChargeBee. We also do some of that work ourselves. I mean, again, I think part of it is how complex your revenue role is. What we typically advocate, if you've got under 100 logos, that's something that likely you can manage, and even up to probably 150, 200. If you're spending an inordinate amount of time on RevRec and on analytics reporting for your customer base, that's when we typically recommend starting to look at a subscription management tool. But again, happy to kind of talk in more detail there and share feedback. It's kind of a contextualized conversation based on where you're at and how you're looking at data. But really QRR, ARR, MRR, it's all kind of the same data typically that you're looking at. I think the one real variant there can be around contracted ARR. So that'd be more like CAR or contracted monthly recurring revenue. That can make things a little bit more difficult. So if you're booking a deal, say this month, but you don't start recognizing revenue on it until January, where you actually see a lot of this behavior for larger enterprise type customers, that's another metric to track. So this would, to clarify, this is more kind of current period based. If I book a deal on September 30th, the last day of the month, I'm going to get full monthly recurring revenue credit for that and full ARR impact credit for that. But on a revenue recognition basis, so more on a GAAP basis, I'm only going to get typically, 1 day of credit, or depending on your policy as a company, you may even push that into kind of the following period. So a lot of different ways to kind of look at that. So hopefully that's helpful. Happy to clarify further there though after the session, if that'd be helpful though.
Yeah, that was really helpful. Thanks. And one more as it's relevant to this slide. Lisa's asking, how do these metrics or formulas change, especially around churn, if the business model is a monthly billing model versus annual?
Yeah, it's a good question. I mean, I think to me, the biggest impact is you're likely going to see a pickup in churn. It's just hard to kind of navigate out of that. We typically see more month-to-month billing activity amongst SMB type customers that they're used to paying month-to-month. So it makes it a little bit more challenging. But what I would say is typically, again, you're going to be able to track this stuff in the same way. You're probably going to see a little bit more fluctuation when you start to look at lost expansion and contractionary revenue. One thing that we advocate for is writing good rules around that. So if you as a business think that you want to recognize, you don't want to recognize churn until somebody's left your platform for 3 months or 6 months, or if you want to identify customers that may fit a trial label, that's one thing that we'll utilize to kind of drive and normalize some of these metrics. But it's important to be kind of true to your business model. If you're just doing that to kind of make the numbers look a little bit better, that's one thing, versus if it's actually kind of a true consistency of your business. If people are hopping on and off, what you don't want to do is maybe follow the letter of the law, because you may end up, if you're kind of writing rules or formulaic-based logic, you may take one customer who hops on and off the platform 4 times in 1 year. That may show up as 4 new customers and 4 kind of churn customers, where you may want to kind of smooth that out. So those are things that can impact customer acquisition costs. They can impact your effective net retention. So it's one of those things where if you're able to isolate some of those variables, that can be helpful. But I'd say more broadly speaking, you're probably going to see a pickup in terms of gross revenue churn, and even net revenue churn is likely going to be a bit higher as a result too.
Okay, great. Maybe let's do one more before moving on to the next slide. And of course, we'll pick up with more questions later. So Will, you touched on this, moving to annual payments being the ideal. So Emmanuel is asking, if you move to annual subscriptions, then your pipeline number is going to be affected because people don't like long-term contract commitments. So how would you attack that situation?
Well, it's different for every business model. And I think it's a really good question from Emmanuel. What I would say is if part of this is driven based on how your organization is kind of driving their goals, right? It may be more of an impact for kind of a sales and marketing team if they're being compensated based on total dollar value. But aligning spiffs and incentive comp based on doing more annual deals, ultimately it's driving more cash for the business. That's more money you can invest in sales and marketing. That's more you can pay salespeople for selling these deals. And that's more you can pay customer success likely to kind of renew these deals. So ultimately, while it may impact optically, what that pipeline number looks like, and it's less of a bogey that's person chasing, it's going to make your life easier in terms of paying commissions because you're not going to have to worry about, collecting an invoice from somebody every month. Not to mention it's going to make their lives easier because they're closing that deal. They're likely getting paid more upfront on that commission if you're getting paid upfront annually. So to me, there's a lot more pros that outweigh the cons there. But what I would say is it's unique for every business. It depends on how people are used to buying, a product in your space and how they think about that. So, it really kind of depends from that perspective. But I would say a vast majority of the time, everything within your business is going to work better in a scenario where you have more annual payers than monthly payers, and being able to move from that, it just drives more efficiency across the board, and you're gonna have more cash in the bank. So it's more that you can invest within the business, which I think is, probably the biggest kind of proponent of moving to that type of structure.
Yeah, makes a lot of sense. Great. Thanks, Will. We'll keep your questions coming. And if you want to vote on the questions, we've got nearly 200 people in here. So please go and vote on the questions you're most interested in discussing with Will. And we'll jump back into that after the next slide.
Cool. So cash flow metrics. This is something that we've started to incorporate and focus on a lot more with kind of the rise of COVID. So why is this stuff important? Obviously, cash burn is something that everybody in here is tracking to some degree, regardless of what industry you're in. What we would typically say is think about, outside of the box expenses that may happen, and just be kind of thoughtful around that. And then alternatively, if you have accelerated, there are a lot of businesses, especially landlords, lessors, other people out there who obviously have been pretty negatively impacted by this. So if you're in a better cash position, there's likely opportunity to negotiate, some better terms. You may have to kind of prepay some of this, but we've seen a number of our clients utilize this. We've utilized it ourselves to drive a little bit more efficiency around kind of effective expense. So if you have been in a position where you're able to drive a little bit more efficiency there, it's one thing to look at. And then DSO, normally not an area where historically we spent a ton of time. We didn't see much fluctuation. What we have noticed across basically our entire client base is a rise in days sales outstanding. And what that really is tracking, how quick are your customers paying you once you've invoiced somebody. So with kind of the rise of COVID, I think we've seen a lot of folks that have, whether they've been impacted economically or whether they've got a lot to worry about, with their headcount or kind of OpEx, they're typically starting to slow pay, receivables a little bit more. We've seen it again within our own business to some degree. So what we would always recommend in terms of forecasting is really being conservative here at the end of the day, and not assuming you're going to get paid as quickly as you were getting paid 6 to 12 months ago. That may not ring true for your business, but from a forecast standpoint and from a cash flow standpoint, we think it's a really critical thing to point out because it's very easy to just kind of flatline your days sales outstanding assumption. And then when you start to realize your cash is coming in lower than what you forecasted, this is probably going to be one of the big reasons why. So with that, I think we can hop to the next slide. Yeah, so from a cash flow, from a customer unit economics standpoint, these are where we also spend a lot of time. This is kind of an area where we try to identify and measure how a business is performing. What I'd say for this example customer, fantastic LTV to CAC ratio. A typical suggestion there. Ideal range is 3 to 5x. A good baseline for months to recover CAC is about 12 months. And obviously this will be industry dependent and depend on a number of factors. And what magic number is really calculating is how many dollars of kind of subscription growth am I achieving for my sales and marketing spend the prior quarter? This demo business is knocking out of the park on all fronts. But actually what this is really telling me, it's flashing red lights, right? This business is actually leaving a lot of growth on the table. and probably have a lot more room to invest in sales and marketing and be less efficient, because right now they're likely leaving growth on the table based on the effectiveness of their sales and marketing spend in the prior quarter. So this is one thing where, again, it's more important to look at the broader story and look at everything across kind of the context of the whole business. You as a business may have similar metrics, but may not be in a position to go spend here. But it's important to identify these opportunities, continue to track and monitor them, so you can kind of make recommendations and drive better performance moving forward. So outside of that, again, I think one area to think about for months to recover CAC, that's kind of a nifty rule to look like, is looking at your payback period for each type of sales and marketing spend. So if you're able to do that and get to that level of granularity, it makes it very interesting. So if you're looking to kind of either cut back on sales and marketing or be a little bit more thoughtful there, you can almost look at it on a channel by channel basis to identify how you want to attack that. But yeah, with that, I think that's probably a good summary there.
Great. Let's see if we have any questions on this topic. I think this one is more going back to the previous slides, but can you touch on negative churn?
Yeah, so I mean, net negative churn is, and you're probably better off going just to the next slide. It actually has the full dashboard, so maybe a little bit easier to kind of talk through some examples here. So let's wait till that pulls up here. This may be a little bit harder to see, but I think, again, we'll be sharing this stuff afterwards in case you're wondering. So if I'm looking at net revenue churn, right, that's where you can start to achieve negative churn. What you're seeing here is, if this expansion line where, in January we've got 5K, February we've got 4.5, May we've got, 4,000, where you can start to achieve, and there actually is net negative churn here in May. If you're able to exceed, the amount of hard churn that you would have from a loss standpoint with your expansionary revenue, you're able to kind of achieve effectively net negative churn. So obviously that's a great goal. You're seeing a lot of the enterprise SaaS companies that have IPO'd over the last 12 to 18 months. A lot of them are very focused on net negative revenue retention, so exceeding that 100% number. One thing I would say there, a caveat, I wouldn't put too much weight into the public numbers. Everybody's got a different way to track this. There's 35 different methodologies, I believe, across the 40 plus SaaS companies. So everybody's got a different way to look at churn. It's not a GAAP metric. So there's a lot of creative accounting going on that front. But what I would say here, again, it just depends on your business, how you like to track it, and where you're kind of trending, right? Your net negative churn may not be as reasonable for a business that's selling, $50 to $100 annual deals that's focused on the SMB space. So I think you start to see a rise there as you go further and further upstream with more enterprise clients, but it really depends on the business. The other thing here too is with our definition, and this does differ based on who you're talking to, how you look at it. We do not include soft churn in our gross revenue churn number. We just include hard churn, so people that have officially left. We include lost, expansion, and contraction within this net revenue churn number. And again, look back on it on more of a last 12 months basis and try to annualize the number to look at that data a little bit more efficiently. But hopefully that answers your question.
Great, thanks for that. Let's have another look here. Johan asks, instead of having account codes for specific teams, why don't you use tracking functionality that some accounting functions have?
Yes, I mean, I think our goal with our process, and so the chart of accounts we shared earlier is really for simplification, and that's just part of our process. So really, at our core, what KPI Sense does is we take transactional data and we take your financial statement data and bring it into a picture where it's going to be a lot easier to analyze and kind of forecast that information out. So what we found is that there's businesses that have 50 line items in their chart of accounts, and there's others that have 500 or 1,000. Our goal is really to simplify that to a point where it's easy to kind of understand and maintain it. But what I would say, there's no right or wrong answer there, right? I think there's plenty of folks who probably have a great chart of accounts. Really for us, and really the reason we kind of brought it up was more to talk through making sure that it's organized in a way which you're not, cheating yourself from a gross margin standpoint or impacting those metrics in a way that are going to be less efficient. So hopefully that answers your question. And I've actually I see a question from Tiffany that I want to grab real quick because I think it's great.
Yeah, go ahead.
How do you handle LTV and CAC when rev is lumpy? That's a really good one. And again, what you see down here, I actually left it in here. I have last 6 months. So what I would advise for LTV, for CAC, for all of these kind of customer and economic metrics, it's really important to look at it as a basis of how that business sells. So if you're selling very large enterprise deals, you may go 2 months without selling anything and then sell 3 deals in 1 month. If you're using LTV to CAC and these metrics by the letter of the law, you're going to just see this giant roller coaster chart. It's going to be 30 and then 10 and then 30 and then 10. What we advocate is looking at a more broader time frame. Again, the whole goal here is to get good trended data so we can drive better decision making. That 30-10, 30-10 doesn't tell you anything, right? You're not going to be able to do much with that. So for us, it's really kind of looking at that information and trying to build a more guided view of what that looks like over time. So great question. I would recommend kicking out the time frame that you're calculating that over. So look at a last 6 months basis. And if you're a really large enterprise client, you could even consider using a last 9 or last 12-month basis to calculate that.
Awesome. Thanks for that, Will. And another great one from Doug. What are some KPIs you track for pre-revenue SaaS?
Oh, that's a good question. We personally haven't worked with too many companies that are pre-revenue, to be candid. But what I would say, what's going to be important are kind of operational drivers, utilization, without pre-revenue metrics, especially if you're looking, using this in the context of appealing to investors or thinking about an investment round at some point. What I would probably point to is more around utilization, signups, active users, a little bit more operational. And there's definitely work that we do that tracks this. With this example dashboard, we were a little bit more focused on kind of financial drivers. But wherever you can get scalable operational data about the business and pull that down in an efficient way, especially if you believe it as a source of truth, definitely a great thing to start to incorporate. But I would say some of that's probably unique on your business in particular.
Okay, excellent. All right. Do you want to take some more of these questions? I can barely keep track. There's a lot of them now.
Yeah.
Or we have a few more slides to get to as well.
Yeah, is there any way to mark them? The ones we already answered today, do they get cleared out?
They don't.
Okay, well, I'll try to jam through these. Let's do it.
Okay.
All right, so starting from the top here, David, from a P&L perspective, are there suggested standard margin contribution levels more relevant for a startup than established business? That's a really good question. For a SaaS company, from a contribution margin standpoint, I don't think there's any kind of perfect figure there. What we tend to see, if you're a pure SaaS company, trying to target kind of in the 80-85% range is a fairly good bogey. You may have less customer support costs. You may have less, I'd say kind of hosting costs. So there's some ways to kind of, I'd say, play with that. But a rule of thumb that we look at is if you're in that 75-85% range, that's great. It also depends on how much services you do as a business. If you have a large services component to the work that you're doing, that's likely going to drag down your effective gross margins. So one tip that we would provide there is trying to look at your subscription exclusive gross margins. What are your SaaS driven costs versus non-SaaS, and look at those on an isolated basis. Then you can kind of calculate LTV to CAC and some of this gross margin driven work off of that versus kind of your full effective gross margin figure.
All right, awesome. Let me see if I spot any other ones here. From Julie, would you include recurring transactional non-SaaS revenue into these kinds of analyses where the revenue is recurring but variable or seasonal?
Yeah, that's a really good question, Julie. And that's kind of one of the examples that I mentioned just before. I think it depends on how your business works. If you have somebody who it's recurring or seasonal, I don't think there's an issue with that. Really, it's writing rules around that. And you kind of have to look at it on a case-by-case basis. If you know that person is going to pay, 3 months from now, and then 6 months, 9 months, and there's predictability to it, absolutely. I don't think there's any issue with kind of showing that in some way, shape, or form. What I would say is trying to isolate what is truly recurring or reoccurring versus what is truly variable. One thing that we've seen folks get into a bit of a mess with is trying to bake in truly variable revenue. So something you're getting off of a percent of a transaction, or something that again is truly going to fluctuate on a month-to-month basis. Trying to incorporate that and look at recurring revenue data for that, it can be really challenging. So trying to isolate and look at what you believe is predictable and at least semi-recurring or reoccurring is kind of, from what we found, the most effective way to look at that.
Great. Okay, let's do one more from Lorenzo and we can finish up some of the slides. How do you account the MRR for any customers signed up with a discount promo, and therefore the churn of these customers once the promo runs out?
Yeah, so that would be a great one on a trial basis to kind of mark down. So how we typically think about it, if it's truly a discount promo where they're paying, it's not like a 10 or 20% off type thing, and they're not signing up for an annual or longer term contract, we would tend to think about those as kind of pre-funnel or trial-based users. So if you're looking to drive, I'd say, more efficiency from your net revenue retention profile, you're likely going to be better served by marking those as trial and counting those separately and not keeping those within subscription revenue to avoid having to take churn on that. Now, if you've got great trends with those trial customers, they convert at a massive rate or they're signing long-term deals on average, you may get more of the benefit of lumping that with subscription. But again, I think it's just one of those things where it's likely better to isolate it to start and kind of analyze what that data looks like over a longer time frame, and then go from there before kind of trying to roll that up and pull that into subscription revenue.
Awesome. Okay, well, let's finish up the slides, and there will certainly be more questions. Oh,
yeah, well, I mean, the rest of the slides, we're
Okay.
basically done. The rest of the slides are appendix just for how we calculate it. So some of these questions, it could be a little bit more impactful, thoughtful on that front. But yeah, that's largely it from our side. Again, I think most of this is just more methodology, how we as a business tend to think about some of this work. But yeah, and again, happy to keep answering questions and go until the wire here if that'd be helpful.
Yeah,
otherwise,
absolutely.
if we do miss anything, happy to follow up afterwards and get kind of a list of outstanding questions from the team, and I can circle back to everybody individually if that'd be helpful.
That's awesome. Will, I think you're going to be very popular in our Slack group after this. Yeah. So prepare.
Slack, email, yeah. So, and we can put it in the slide here. It's my email address is just will@kpisense.com. So if you've got any questions, feel free to shoot me a note. I'm also in the Slack channel within CFO Connect. So happy to try to be helpful in whatever way possible. Again, we are, as an organization, very focused on driving value and trying to help people out. If you're looking at data more efficiently and better as a business, regardless of if you're a customer or not, we're happy at the end of the day. So happy to try to be helpful in whatever way possible.
That is fantastic. Well, thank you. There are a few more questions, if you wouldn't mind. Let's see. Sophie asks, how do you manage refunds in the calculation of recurring revenue when a user starts a subscription but asks to cancel during their first 14 days, so they're entitled to a refund of their subscription?
Yeah, I mean, that's a good question. I think that there's a number of ways to account for that. We've seen that in a couple of different ways. One thing that I think you can do is running a soft close on your financials and being able to go back and kind of work through that, or using the trial balance close to analyze the data initially, and then assuming after that refund period is up, closing your books as of the 14th, 15th business day of the month to incorporate that. One thing with refunds too is on a P&L standpoint, it's easy to bake that as a kind of contra item within the P&L, within the revenue category. But where it can get a little bit trickier is on kind of the recurring revenue front. So trying to isolate those customers that are eligible for that is one way to kind of look at that in an efficient way. But it really kind of depends on the business too. So hopefully that answers your question. Sorry if that's a little vague. But without more details, again, it may be a little bit more of a unique question based on your business.
No, I think that helps. Let's see. How would you calculate KPIs? This is from Mate. From a time frame standpoint, for example, customer churn percentage, annual subscriptions. So would you use a periodic view where you divide churned users, or a cohort view where you divide churned users? Churned users with opening users, or churned users versus new users?
Yeah, it's a great question. What we typically do is take more of the periodic view. We will typically do more of that cohort-driven view as well and get into the weeds on that front. I'd say for the summary level dashboard that we walked through today, it was more of a periodic view. So you can either take the effective, expansion, contraction, and new business lost business to kind of calculate that across the whole year and use kind of MRR averages. You can sum up the last 12 months from a percentage basis, which is a little less scientific, but again, assuming you've got a pretty standardized format, it's going to be a pretty consistent view of where your annual churn lies. But I think it depends on the business model too. I mean, if you're seeing a lot of folks that are paying late, you may mark them as a lost customer, and then 2 months later they're back from the dead and they're their customer again. It really depends on, again, how it's efficient within your business and how people pay and what those behaviors look like. Most of the subscription management tools out there, they're going to assume a customer who doesn't renew on the renewal date is a churn customer. So some of these things are a bit nuanced. You want to look at it for your business, what's going to be more efficient. Our view is more, from a periodic standpoint, you're getting a little bit more upfront value in the sense of if you're going to use that type of assumption to drive, net revenue retention in the future, from a forecasting standpoint, we're very, forward looking from our perspective. That data can be really helpful there. The cohort stuff is going to be valuable too. It's just there's a little bit more nuance there in terms of how you're looking at it. And you get into the cohort view, there can be a lot of fluctuations and variability there. So I'd say that's a little bit more effective for kind of deep dive or more granular analysis. So hopefully that answers your question.
Great. I think you've been answering all of them like a true expert. So let's see if there's anything else we can get to here. Valerie asks, how are overages accounted for within MRR and ARR?
That's a great question. So we think about overages typically as more more variable revenue. It's not perfect, but because you're going to see a fluctuation there, we think it's one of those things that's likely more efficient to measure as a separate line item. We have a couple of clients that have elements that are pay to play or that are usage based. For us, it's a little bit more efficient to measure that separately, because if you have a group of customers and there's a ton of overages one month and then none the next, you really don't want to take that as a effective a contraction within the business. It's going to really impact your net revenue retention negatively. Now, you could get a benefit from that in the short term, but what it does, it's going to show a much choppier story. So if you're thinking about this from an investor standpoint, from a board standpoint, there's probably good and bad there. But likely the best way to handle that is just to separate it and not incorporate it in MRR ARR, because it really isn't recurring revenue. There's inconsistencies there. There's variability there. Anything with a volatile or variable path is likely going to, in the long term, dilute your kind of metrics from a net revenue retention and churn standpoint. So that's our perspective. I think everybody has a different view there to some degree. So, and some of that's dependent on your business, but that's how we typically look at it.
Sounds great. Perfect. Well, we definitely could have had more time with you, Will, but we'll continue this conversation in other forums.
Tiffany, and let's grab all these questions. Anything that's open that we didn't get to, I'm happy to circle back either directly in Slack. Feel free to ping me if you're in there. If not, shoot me a note, and I'll get a question list from the CFO Connect team. And if I did get a chance to answer your question here in real time, happy to answer it directly. But yeah, feel free to reach out. Happy to chat further. And if anybody ever wants to talk SaaS metrics and more in depth, I'm happy to talk further.
Sounds fantastic.
This is helpful for everybody.
Yes, Will, you are certainly the perfect person to speak to this topic. So thank you so much for the detailed and really just nuanced presentation on this topic. Again, it's there's a lot more to explore. So we're thrilled that you're in the community, you're in the Slack group. We'll certainly do some more maybe small group roundtables with you so we can dig into more specific use cases. But do we want to finish with one more question since we have time?
Sure, let's go with a bang.
Yeah, let's.
Yeah.
All right, Tiffany asks, what is your thought on adding gross margin percentage to LTV and CAC calculation?
Yeah, so we definitely do that. That's a great question. We look at LTV and CAC on a contribution margin basis. There's times where we can separate that, and what we actually call that, if you don't use contribution margin, is really looking at that on a more of a kind of a cash flow or a pure basis. There's value to both, but I think if you're being honest to yourself as a business, you're going to be more, you're likely going to be more efficient showing that on a contribution margin basis. So for everybody else in the room, from an LTV and CAC standpoint, whether or not you include gross margin is going to obviously impact the long tail of that customer. So if you have a effective 10% churn, that customer, your average customer life is going to be 10 years, right? So what an LTV to CAC analysis is typically doing is a DCF, a discounted cash flow of what that customer looks like over time. If you don't include the gross margin, you're obviously not including kind of a cost impact or an offset to that. So it's probably showing, again, a bit of a rosy view. But one thing I would say to that point, to Tiffany's question, which I think is awesome, is really thinking about it. Is that gross margin impact, is it related to the SaaS revenue? If it's services or there's some other unique element to your business that isn't impacting the SaaS revenue, I wouldn't incorporate that into that gross margin view. If it's a large majority, if it's services and that cost to deliver those services are a small minority, it's probably not worth the couple of percentage switch. But it's a great question, and one that we will actually look at on both sides of the coin at the end of the day.
Okay, great. Hopefully that helped, Tiffany. Well, these are incredible insights, Will. Thank you so much again. You're getting lots of thank yous in the chat. And again,
yeah, it was great to be here. Actually, let me answer this last question from Simon, because I think it's a really good one.
Great.
How would you manage ARR and MRR reporting during these COVID times where a customer might temporarily suspend their subscription? So that's a really good question. If somebody is on a temporary hold, or you think that they're going to come back, or maybe they're just having some payment issues, that's a perfect example, and actually something that in this dashboard I didn't show, but we actually have more of a kind of a midterm bucket in our typical MRR ARR role that allows for customers that are suspended or transitionary in some way, where you can kind of gather that impact without officially marking them as churn. So really good question. I think you want to define that as an organization. How many months does it go before you mark them as churn? It could be 3 months, it could be 2 months, it could be 6 months. But trying to stick to that organizational definition, it's going to help you as a business. And also, if you're thinking about it and eventually showing this data to investors or other stakeholders, you don't want to have that definition be too fungible and spreading around too much, because it can cause some heartburn if during a due diligence process or other things along those nature. We've actually seen this kind of come up before with one customer in particular that I can think of, where this was kind of more of a painful type of issue. So, but yeah, great question, and one that you definitely want to look at on a case-by-case basis. But if you're able to make a definition there to kind of define it, I think it's obviously going to help, and you can potentially isolate stuff that you may consider churn or you may not consider churn, and kind of put that in a different bucket to show that there's an ability to recapture that revenue if somebody's kind of paused temporarily. Yeah,
that is a super important question. I'm glad we got to touch on that before we close. So just so everyone knows, I know there's still a lot of people on here. So what we're going to do with this great information that Will shared is we will send out the slides. So you'll get an email tomorrow that will include the slides. We'll also do a blog recap of the key takeaways that could be helpful to share with your colleagues, other SaaS finance folks who weren't able to join today. And there will be a replay available as well. So thank you all so much for joining, and thanks especially to Will. This was really super helpful. So thank you so much.
Thanks, Don. Appreciated the time and excited to dive into more questions later. But thanks a lot for having me.
Thank you. Have a good one, everyone. Bye-bye.
See ya.
Thanks.